These aren't one of those unicorn type properties, are they, Jay? These are fairly not fairly common. You have to work hard to pick this out and find the right lot, find the right builder, stuff like that. But you do have these options available, do you not?
Yeah, 100%. I mean, that's the whole the name of the game, I guess, for us is to be able to create that supply line of properties that will perform well long term. Anyone can go out and buy a piece of real estate. That's easy, right? But will you be able to rent it year over year and take your cash flow and put it down on your mortgage principal reduction or buy more assets with it is the question.
Hey, everybody, there's an old rule in real estate that says buy low, sell high. I'd like to add something to that. Buy low, sell high, but always buy for cash flow. I'm Russell Westcott. I help real estate investors start, grow, and scale the real estate investing portfolio of your dreams. So if you're interested in analyzing properties, if you're interested in buying properties that cash flow, ones that will stand the test of time, ones that will make you money over the long term, you will need to learn how to analyze properties. In this video upcoming, my business partner and I, Jason Mattern, dive headfirst into proformas. How do you analyze cash flow on the properties you're about to purchase? We go deep into the analysis. How do you analyze a property? We go literally line by line on a proforma, where you find the numbers. How do you analyze the numbers? And we wrap it all up with a wonderful case study. So in order to be a long-term successful real estate investor, you need to follow the formula of buy low, sell high, and always buy for cash flow. So enjoy this upcoming video. Let's go. Hey guys, welcome back. Russell Westcott here. So again, I have my good friend, Mr. Jason Mattern on the line here today. Jay, how are you doing today?
Afternoon, Jay? Russell Westcott. Doing well, thank you.
How awkward of that? It's like we've never done this before and we've never had one of these conversations, eh?
We're getting there. Hey, we might be getting good at these actually.
Well, let's hold our judgment until the end.
Yeah, exactly. Yeah.
Well, Jay, what I wanted to do here today is I wanted to dive into a conversation. We're going to keep it fairly loose, but let's keep it really educational. And I also wanted to follow up on something that's been coming out through some conversations that I've been having with investors across the country. Now, it came from where you and I were having a conversation. We had this conversation about proformas, and we had this conversation about what we call proforma shopping. And we had a conversation about how do you read a proforma. So what I decided to do today here, and this could go horribly wrong, but we're going to do a screen share session. Us low-tech hillbillies, if you will, are going to try to do this on camera, a screen share, and we're going to walk through a couple things, almost like maybe like a consultation. And then we're going to walk through a proforma. We're going to educate you on what a proforma is, and we're actually going to share with you what a proforma looks like. Does that sound like a good plan, Jay?
Yeah, that sounds good. Yeah, it's again, Russ, it's information that is maybe not out there, and I think it's just a different take and a take of just being in the trenches and seeing not only the mistakes I've made, but what other people make, and just getting better at it, right? Getting better.
Yeah. And so, Jay, so what did you mean when you said a while ago? So let me back up. Let me ask a better question. First of all, Jay, what is a proforma? Like, what is a proforma from your opinion? What is that?
Well, I think a proforma, or as I call them, and many of you watching will know this, I call it an IP, an investment property analysis. But to me, a proforma is a projection of how things should go. So when we're looking at any piece of real estate, one of the first qualifications that we're doing is we're, extracting the information from it, with list price and potential rents and taxes and potential insurance and, allocating a management fee and a maintenance and repair and a vacancy allowance and stuff like that. And really plugging it into, I guess a quick snapshot of if these property, or the potential property or subject property is even worth taking the next step. We're looking at, on our end, a debt coverage ratio. We're looking at, obviously, the cash flow, and maybe looking at an annualized return as well.
Yeah. So best case, it would just be saying it's a snapshot of potential future financial projections.
It's a snapshot, yes, with a bunch of question marks hanging over it. And based on the outlook of the pro forma, it's time to either move on or start confirming information, right?
Yeah. Now, one of the recent videos that we put out with talking about the three biggest cash flow killers that you talked about really struck a chord. It's actually it's getting a lot of traction, and it was the comments were this was an interesting, fresh perspective that people have not ever looked at. A lot of people will sit here and they'll analyze the numbers up front. They won't, analyze, how do we reduce the maintenance? How do we reduce the vacancy? How to reduce turnovers? All those kind of things. And I think the one thing that you said really struck a chord for a lot of people is if you actually have to put a furnace into that place in year 3 of operation and you have to spend $9,000 or $4,500 or whatever the number is, what is a furnace now? Is it about $5,000-6,000, isn't it?
Yeah, 5 for sure, all day long.
Especially if it's a high efficiency and you have to do some plumbing to get the exhausting out. Like, for example, if you have to put that $5,000 furnace in on year 3, but you don't have enough cash flow to account for it along the way that's coming out of your pocket, very few people will actually add that $5,000 to their initial down payment money to then calculate their true ROI on a property. And
well,
go ahead.
Yeah, sorry, it's seed capital, Russ. Obviously, we're spending money to buy these things with down payment, which we typically calculate our longer term ROI from. But if there are circumstances like what you just explained, where there's capital expenditures along the way, and we do not have enough cash flow to cover that, in reserves, it's got to come from somewhere, and in most cases, you can't leave it. In Edmonton, you cannot leave a furnace, out of service. So it's got, whether you're, putting that money in from your own cash or if you're using it from another credit line. Again, I think the word I used is inherently is going to change your long-term ROI.
Yeah,
Definitely.
Absolutely. Well, here's a quick story I'm going to share with you. So when we recorded our first one back in February, it was like minus 400 in Edmonton, wasn't it, Jay? I have the joke that I say is, on a thermometer, there should be no numbers below minus 20 because it just doesn't make a difference after that, right? If it's minus 40 or minus 27, I challenge you to find the difference between those two numbers, right? Okay, but here's the story. So I had one of my property managers sent me an email note on one of my new construction properties that the furnace went out on one of the properties. My comment was, "Oh dear," I 5 words back, "Oh dear, please fix," right? I guess that's 4 words, right? So he went out, they sent somebody out to go fix it, okay? It was under warranty because it was a new construction property. I had to pay a little bit of a truck dispatch fee because it was an emergency. Came back, the property manager took care of it. It was under warranty. It cost me about $200. And the property manager took care of it. Everything went onto my statement. The statement went from my property manager's portal to my bookkeeper to do taken care of. It took me less than a minute and 20 seconds and 2 email notes to handle a new furnace or for a furnace repair to be done on my property.
And 4 words.
And literally 4 words and a couple different emails. That was it.
Russ, it's something that people, I think, need to know about, especially, and it's not even new investors, people because, I still have some older stuff myself. And I guess as the market permits, we're exiting those and moving into new construction. But again, I've used the term, I'm a living, breathing example of these things. And it's not, again, as we're alluding to in the pro forma shopping, it's in the black and white on financial statements year after year after year. And this is something I guess I've heard my dad say this so many times over the years. It's not what you make, it's how much you can keep. And this is a live example of, making a lot of cash flow or a potential good sum of cash flow every year. And if we're taking that money and we're pumping it out the back door in repairs and maintenance or vacancy costs, by the way, could potentially be the largest expense on one's financial statement long term.
Yeah.
So if we can take those costs and, mitigate them or if not eliminate them, it allows us to keep cash flow and put it on more important items like mortgage principal reduction. Yep. Or if you're still in acquisition mode, buy more real estate.
Yeah.
Right.
And the better your financial statements look, the better you can qualify for your next property, right? If you have the black and white numbers, that's showing good performance on, your taxes statements and your year-end T776E forms, and you have better, stronger performing cash flow that can help you the next time you acquire another mortgage.
Well, even Russ, one step further and just break that down a little bit more. If we're talking, say, about timelines, because a lot of people, are on a timeline of when they want retirement income. A lot of people are doing this for long-term wealth or part of a retirement plan or income replacement plan. If you have an extra $5,000 or $6,000 a year, and that's $500 a month cash flow, and that's not unreasonable. That's common in today's real estate market in Edmonton to get that type of cash flow. But if we've got $6,000 a year cash flow, and we can take and build a good reserve in year 1 and 2. But by year 3, we're taking that $6,000 and flopping it down on mortgage principal reduction. How that decreases your amortization, to where you are decreasing your time to actually get the true cash flow from the property being a clear title property.
Yep.
So it just helps the big picture overall.
No, I agree. And so here, here's a question I'm going to ask. Before we jump into a pro forma and we educate on what a pro forma is and how to read it and just where do you find numbers and stuff like that. What did you mean when you said about it's not what you see on a pro forma, it's what you don't see? What did you mean by that?
Boy, there's a good question. So when we're looking at a pro forma, again, it's a projection where we're looking at, specific items, and we're looking at the performance, the financial performance of how this property should work. Okay. Now, part of a key ingredient of owning real estate and having a successful, term of ownership with real estate is maintaining tenancy. And if we're buying a property that, is not maybe in the best area, or it's not conducive to attract that perfect tenant profile that we want, and we're susceptible to more tenant turnovers, this is where it's going to affect not your pro forma. Your pro forma is long gone. It's where it's going to affect your financial statement. So what I mean by don't see is that there are things past the pro forma, like to make sure we have on-site parking. This is Edmonton. People still drive here. Matter of fact, most people drive trucks and SUVs, right? So we need on-site parking. I'm looking for things that I call co-tenant issues or potential co-tenant issues after the keys are handed to your property manager. So things like noise, smell, privacy, parking, separate laundry facilities, separate entrances. Because if a tenant's leasing this, they're going to be looking at this stuff. And more importantly, if they're in a situation where they have, a noise situation or they're having a smell situation, it's going to cause a tenant turnover. So what I mean by stuff that what you can see on the pro forma, yes. Now we got to look at the stuff that we can't see on that pro forma, to take the next qualification with that property to actually determine if it's going to be a good long-term investment.
So here's the best way I could describe it is you take a look at, first of all, the financials and the numbers. And then you actually do one layer deeper of taking a look at it from a standpoint of who's going to be living there and the customer and the ownership experience. And you just risk mitigate what can go wrong in advance. And that's really, I would say that's a very sophisticated look at how you analyze a piece of real estate. Would that be a nice bookend to what you just said?
Yeah, I think so. So analyzing that property, but like I say, the whole point of buying a piece of real estate is to rent it to someone. So if there's, again, parking is a big one. If there's not enough parking, you're going to have tenants that are going to come and maybe look at it, and they're not going to rent it because there's no parking. Yeah. If we can offer on-site parking, we can offer separate laundry facilities, we can offer, privacy, separate entrances, all these sorts of things that we know based on literally years of feedback loops from our tenants and our managers and our owners, and we can bring that to the front lines and say, here's, a property that will perform well, and here's why. It just makes sense.
Yeah.
And like I say, it's that long-term view. Again, I'll focus on the financial statement, not the pro forma.
Yeah, you just stole my next question, and I was about to say, so where did we learn all these things from, Jay? Where did we learn some of these challenging things and challenging times of waves of and where the costs are and where all the I call them leaks, if you will, cash leaks, energy leaks, time leaks, just pain in the backside leaks, if you will. That's a different problem we have to solve, eh? Russell, you need to wear some diapers there, brother.
Yeah, strap them on, buddy. If you need them, wear them.
Jay, come on. I've given you some gold nuggets here, and you're just not even, I'm putting it on a little ball on a tee here for you. You just normally knock those out of the park. You're being a little too formal on this recording stuff.
I'm going to keep it polite. Yeah, I'm going to keep it polite. Yeah.
You're going to keep it PC, are you?
Get to know me a little bit. Yeah, for sure.
So yeah, okay. So, but after talking about the leaks out the backside, if you will, so now we'll just transition.
But listen, Russ, on that last topic, that information that we talk about moving, let's just say, I'm a long distance investor and I have a property manager here and they can't rent a property for me, or there's an issue and the tenant leaves. I don't know if investors are actually asking, well, why did they leave? And, why are they not renting it? Again, it's that feedback loop that we as property owners, because the buck stops here. You're the one on title. You're the one that, ultimately is responsible for this situation. If a property is not renting, you need to understand that. And going back to your comment about understanding, ask me how I know. It's just really, I guess, paying attention, not only receiving that feedback, but actually paying attention to it. And, we self-manage our properties, Russ, so we get a direct feedback, with our properties at least. But these are questions that I think investors need to be asking, their property managers as well. And if a property's not renting, we need to understand why. And if it's something that's fixable, great. If it's not, you know what? You live and learn, and the next property you buy, make sure you remedy that problem right up front at time of acquisition.
Let's get into a pro forma.
Sure.
So I will walk everybody through here. So let's just do this here. Let's share. So what I'm going to do, guys, is we're going to walk you through a pro forma. Now, there's a lot of numbers and lots of stuff here, but we're going to get into some of the nitty gritty and we're going to share some of this with you. But Jay, before you walk somebody through a pro forma, you typically do a little bit of an exercise about kind of budget, like what budget you have. So walk me through. Let's say I'm coming to you. I'm interested in buying. I've heard this bald guy from Saskatchewan on a podcast, and he's talking about Edmonton and all this kind of wonderful stuff. And something tweaked my interest, and I want to have a conversation with you, Jay. And you have like 10 of these a week, more or less. How do you kind of walk somebody through the steps? What's the first thing you do?
Well, I think the document you have on the screen there, Russ, is, and I call it match your investment, to your budget and your lifestyle. So budget, obviously, we each have financing boundaries and parameters that we have to exist with, which are, mainly determined around down payment requirement. The mortgage is the second part of that qualification. Now, the lifestyle part of it is something that I just want people to understand. You can see in the third column there, we've got different property types. And obviously different down payments and different income streams, and of course, different monthly cash flow. But each one of these properties has a different commitment as an investor or a management team to take care of it and potentially get what I'll call optimum performance on the far right-hand side. Here's a monthly cash flow after expenses that includes a management fee and vacancy allowance and repairs and maintenance allowance. But again, that's what we call optimum performance. This is if this thing's flipping over month after month after month.
Yeah.
Again, that lifestyle part of it is to, like I say, every time we're typically adding tenants and income streams, they're more hands-on, Russ, and they take ultimately more time. So one of the things I want to understand with investors is that, how much time do you have to take care of it? And real estate should be an enjoyable ride. The last thing we want to do is, get you into a property to where it's actually going to be a burden, whether it's a time burden or financial burden. This thing needs to contribute not only to your financial goals, but to your lifestyle as well. Right?
Yeah. Now, I'm going to point out a couple things here, guys. First of all, they're not negatives beside them. And these are not properties where you're going to be getting into multiple bidding wars with 17 other people, and you're not going to be holding off on offers. These are going to be properties that are going to be ones that you can do a little negotiation, and there's an inventory of them, and you're not having to pay $180,000 over list prices and stuff like that. So let's dive into a pro forma, and I've got something prepared here. So let's just take, for example, in our conversation, I have access to $200,000. Okay. So let's say from our conversation, it would probably, I got $200,000 and I want some cash flow. So I would probably sit down and I'd go down this chart and go, look, okay, 180,000. Oh, I can get a fourplex for 180, give or take 4 units, 4 rental units, about $1,100. Ooh, that's nice. So then we would go next into the pro forma. Okay. So why don't you walk now? This is kind of this is what you call an IPAJ. This has kind of been your creation, and I've shared this a few times with people, and people, it's not any rocket science around a pro forma of a cash flow analysis, but the
Nope.
way you present it's a little bit different, and maybe let's just walk people through it, right?
Sure. Yeah. Well, up top, obviously, we're starting with a purchase price. And with
Yep.
new construction, folks, like I say, I don't want to use the term generic, but this is, depending on your lot selection and your model selection and the actual options that you're including. But you know what? We are quite easily getting these for $890,000, which is $445 per side. Now, that is what I'll use as an all-in. So that includes the GST. Of course, we've got to pay that. But it also includes more important things like landscaping and fencing and window coverings and, decks and some, upgrades to, maybe some materials along the way or some sidewalks to make it easier for our tenants. So it's an all-in price, our projected all-in price.
Yeah, and why do you build all that in from the start, Jay? Why is it important that you kind of build that into the purchase price from the beginning?
Well, great question, because at this level, we have the opportunity of putting this into the contract for two reasons. A, and probably most importantly, so we can include it in the mortgage. And if we don't, so let's say landscaping is about $6,000, window coverings are another $2,000-3,000, fencing's another $5,000. So, I mean, you could easily come up with a 20% down payment and have to put another $20,000 in on top of this, where if we put it into the mortgage, obviously now we can leverage 80% of the lender's money on top of that. The other reason is that it does tie these items to a contract and performance is part of that contract, where we can get the builder to take care of this stuff. They've got all the trades and people that can take care of it. They can get it done cheaper and better than we can. And we've got things in our contract, which is probably another video, that we'll safeguard that performance and register holdbacks and have all that good stuff along the way.
Yeah. Now, guys, just for perspective, that's $890,000 that we're talking about, essentially for 4 rental units. This is not for a duplex that, like, some of you might be buying out. And I had a conversation with a guy the other day. He was buying out in London, Ontario, and then some other people from Kitchener, Waterloo, Cambridge, and they're paying $900,000 for a duplex, just only 2 units. Okay, so that's what you're getting, is you actually can get 4 properties, 4 rental units, brand new construction under warranty for almost the same price. Okay, so Go ahead, Jay.
Well, I guess just tying down there, like a current annual yield, that's our income into our purchase price. That's something we learned at Rain years ago, and I just kept it on there because it is a very familiar screening tool. The next one down is the debt coverage ratio. That's something that we need to pay attention to. So most lenders in today's environment on new construction real estate included, but on investment real estate, they're going to want to make sure that your portfolio is maintaining a 1.1 debt coverage ratio. And then a lot of times at acquisition, we're finding that they want to see at least a 1.2 debt coverage ratio. And, this, again, is just a time where we can look at the simple screen here. And I mean, I know there's a lot of customers and folks out in Ontario and BC, that are buying properties that actually have, debt coverage well under the 1.1. And, if you're coming in and buying in Edmonton at 1.5 on these properties, it might be a way for you to level up your portfolio and get it above that 1.1.
Yep.
Because if you're buying more than 3 properties, lenders are probably going to start classifying you as, what they would deem as a professional investor, and start wanting to see your portfolio information like this across the board.
Yeah, like, to simply put it, guys, the better the property cash flows, the more friendlier the banks will be. It's just like, and I'm not trying to make this oversimplification, but think about it. If you have a property that cash flows very well, that has a 1.5 debt coverage ratio, the banks are probably going to look at that a little bit more favorably than one that has a 0.9% or 1 even debt coverage ratio.
Yeah.
Right?
Yeah. So think of it this way, is that, we as investors want to make sure the property is going to cash flow. So does the lender. And this is kind of their qualification to make sure that, okay, Mr. Investor, we're going to lend you the money, but we need to make sure that the property, can actually support itself, and probably look at you and see if the property is vacant, you can support it. But in simple terms, the debt coverage ratio, if the property has, say, $1,000 worth of expenses, that property needs to produce $1,100 a month rent for a 1.1 debt coverage ratio, or $1,200 for a 1.2. And that's the simple term of it, that the lenders just want to make sure that the property is a good investment, as do you want to confirm that, right?
Yeah, absolutely. The next terms, the 5% net equity
Yeah,
return and the
yeah.
annualized return.
Yeah, so a 5-year net equity return is basically taking our cumulative cash flow, our mortgage principal reduction, and a capital appreciation rate. You can see just off to the side there, Russ, this is set at a 2% appreciation rate, which is probably in line with where Edmonton is at. And, if you're going to get better, great, we're happy for you. And then
I would say
the
Edmonton was at until just recently, but
yeah, the
that's
numbers are looking
that's another
better.
video, by the way.
That's another video. And the 5-year annualized return is exactly that. It is an annualized return. There is a formula for it. It's not taking the 5-year net equity return and dividing it by 5. That is an actual 5-year annualized return. Now, full disclosure on these pro formas, they do not include disposition costs. So, if that at the end of it, if there's realtor fees that you have to pay and legal fees and all that stuff, those are not included in those numbers. So I just want to be clear about that.
It's based upon just on your initial capital invested. That's what
It's
that first
property
number is.
performance.
Right. Absolutely.
Exactly.
Okay. Yeah. So then obviously we want to find out rents. Now, $5,800 in this example. Where do you get those numbers from, Jay? Where do those numbers come from?
Well, these are real numbers for us. We've got, several of these deployed into the marketplace already, to where those are actually, I would go on a limb and say those are probably conservative numbers, especially on that one. So the numbers are split this way per side. So this subject example here is a side-by-side duplex building where we've got, an upper suite and a lower suite on both sides. And the rental income that we've come up with there is $1,600 up per side.
Yep.
And then $900 down per side, and then the $400 utilities is charged to those. Utilities is typically split like $250 up and $150 down, or if there's more people up and down, but your property manager can work with those ratios. So you basically take those numbers and times it by 2, and that's where we're at $5,800.
Yeah, got it. And we'll get into when we talk about utilities with these properties. I strongly encourage you to charge a flat rate utility fee to the tenants, build it into the rents, because it's actually a profit center. I know in my properties, my new construction properties, because they're so efficient, we're actually making minimum $100, $150 a month, more in the summer than we are in the winter, right? But it's actually a profit center because these properties are so efficient. Good materials, great insulation, high efficiency material use things. We have, hot water on demand, all kind of stuff like that. Lots of different things you can do. Okay, so that's the rent. Go ahead,
Russ. You can see in the bottom of the expenses there, the other is the utilities at $600 a month. So we're actually, that's the cost to the investor. And as you alluded to, a profit center, we're actually billing those out at $800 a month. So, there's extra cash flow on the table there.
Oh, and tenants love it. Actually, tenants love just knowing that they have a one payment and they don't have to get an account. They don't have to get all these utility accounts. If there's any tenant turnovers, it's so simple. You actually don't have to get the tenant to do that. Put it in your name. If you have a vacancy, then switch it over. It's very joyful when you have it in your own name, right?
It's certainly made it more efficient on the management side for sure. And, one thing we probably want to touch on there is disconnection charges. If the utilities are in your tenant's name and they don't make payments, and you don't know about it, you could be subject to reconnection charges, and those are $200-$300 a whack. So having it that way just eliminates that.
Nice. Okay, so the rest is, we're not going to go over everything line by line, but it's typical standard stuff that you would put onto a pro forma: insurance, vacancy, repairs and maintenance. 9%, 2 and 2. Why do you choose? Why are those numbers in there, Jay?
Okay, 9% is with our property management relationships that's what they're offering our customers. I think in Edmonton, anywhere from probably 10 to 15% is normal. I think we've just been able to prove with our property management teams that the new construction properties are easier. And they want more of them, and it reflects in a discount to our customers.
Yep. Yeah. So then you have your expenses. Then obviously you need to get a loan. You factored in 2.19 right now, Jay, or have you built a little conservatism in the interest rate there?
Yeah, you know what? We just did one earlier this week, and it was 1.59% for
I
the
had a client
customer on a
this
5 year
morning.
life.
I had a client this morning that got quoted 1.49.
Yeah, so I mean, it's you know, but at the end of the day, I've always said this, Russ. I haven't had anyone get mad at me yet if they're getting extra cash flow, and I think if we're presenting a conservative, honest projection, chances are they're going to get better,
Yeah, and,
which is
and
great.
you've been in the past of some people when you've quoted this $5,800. Let's say it's in a new construction build, you quoted it at the time, and when the person took possession of it, the rents were actually higher. Were they not, Jay?
I would say that's a fairly common
Yep.
circumstance, Russ. But I mean, it's the old maybe under promise and over deliver type,
Yeah.
right?
And then at the same time, when the person was negotiating on it, they were negotiating at interest rates in like 2.59s, and now they're getting 1.4. So they're laughing all the way to bank. So if you get higher rent, lower mortgage pay down, isn't that a double win?
It just reflects good on the whole situation, Russ,
Yeah.
because just flip that situation around, right? If I overinflated it and they didn't get that, I mean, that's not a very good optic, and that's not what we're trying to achieve here. I mean, it's these investments, again, real estate, it's typically a long-term thing. You're not going to get in and out of these quickly. So I think, if everyone's got the agreement for the numbers the way they are, and you get better, that's a good thing. That's a good thing.
Perfect. Okay, so now we kind of put it all into the blender, and the spreadsheet spits out. It's about 930 in essence for rental income less expenses. Talk to me about these three lines: reserve fund contribution, total cash flow. What is that about, Jay?
Well, the reserve fund contribution, Russ, is $232, and essentially that's the allocation for vacancy and repairs and maintenance.
Okay.
Now, I'm displaying this as your total monthly cash flow is $1,161 a month. Yes. But I want investors to also not forget about, you're going to need these costs. They are discretionary, but you're inevitably going to have a tenant turnover, or you're definitely going to have some repairs and maintenance eventually. Don't forget about it. Don't go out and spend $1,161 and pull it out and, spend it foolishly, I guess. Just, always a good idea to have reserve around. I just want to create the optic for investors that you're going to need this much money eventually. Here's a good allocation to put off to the side if you want. But at the end of the day, just don't forget about it. It's just a matter of time before you're going to need that money for one of those two items.
Yeah. So on those months where you don't have a maintenance repair bill or a vacancy, you potentially could be putting $1,161 cash in the bank. Would that be a fair assessment?
I would say those years, Russ, where you don't have those,
right.
Because, you've owned new construction properties, and, we've got several of them. The repair and maintenance aspect of owning these properties is very, very, very minimal. It's, not even $1,000 a year. It's much, in a lot of circumstances, much less than that. The vacancy one, as I said at the start of the video, the vacancy is the one that, can cost, the big money over time, even in new construction, because if you're not, I use the amount of $2,000 for a tenant turnover because, easily you're going to have to, remarket the property, reshow it, rescreen tenants. You might have to fix it up and clean it up, and worst of all, you might have to sit on a vacant suite for a month or two. So I think with a tenant turnover, $2,000 is not an unreasonable number.
Yep. Now, these are real life numbers. Like, they're not made up numbers. These are real life numbers from a real life property. We wanted to just make it real for you. And truly, guys, this is an opportunity. These aren't one of those unicorn type properties, are they, Jay? These are fairly not fairly common. You have to work hard to pick this out and find the right lot, find the right builder, stuff like that. But you do have these options available, do you not?
Yeah, 100%. I mean, that's the whole the name of the game, I guess, for us is to be able to create that supply line of properties that will perform well long term. Anyone can go out and buy a piece of real estate. That's easy, right? But will you be able to rent it year over year and take your cash flow and put it down on your mortgage principal reduction, or buy more assets with it is the question.
Yeah.
Like I say, people have heard me say this again 100 times, is this is the fun, easy part of acquisition mode. And then pretty soon, in a matter of time, you're going to get handed a set of keys, or your property manager is, And again, that's where the rubber hits the road. That's where you can take this pro forma and run it through the paper shredder. Because, like I say, this is where reality hits, right?
Yeah, absolutely. And I'll tell you what, by owning one of these properties, here's the feeling that you're going to have, guys. You're going to have a feeling of in a good way, right? All right, Jay. So thank you. Appreciate you walking us through that pro forma. Is this a property that's available, Jay, or is this one that somebody's already bought?
No, both, Russ. I mean,
Yep.
there's several people that own these things already in those exact circumstances. And I would say the majority of people that bought are in a better situation with their interest rate and their rental income. But, again, we've had an $890,000 purchase price. But, at the end of the day, whoever's writing the check gets to add and delete options as they want. But it's going to be a very, very good guideline, and it might change, give or take $5,000 per side based on model selection and the lot that we select. But that's going to be pretty tight. It's not going to stray off that too far.
So before we do sign off, Jay, maybe just give some final parting words for people of what you're seeing in the marketplace, just from your words of wisdom about looking at these pro formas and then just out shopping for a property, maybe with some final parting words from you.
Okay, I think the winds of change are happening in Edmonton right now. I mean, we're seeing the excitement. We're seeing the market actually change day by day with inventory tightening up, and things are hitting the market and they're selling quickly. Getting in a panic, I think, is in acquisition mode is probably not the right time to do it. I think, again, we want to look at pro formas, absolutely, but I guess the parting words and I guess parting advice I could give is, just be aware of down the road. And the pro forma, yes, it's an initial screen, but just make sure when you're buying that property that you're going to be able to rent it long term, time after time again. And the easiest way to control that, in my opinion, is to buy the right property in the right neighborhood, that's going to attract the right tenant. It's the 3 pillars of real estate that we talked about, Russ, in a recent video, I think. And in my opinion, the third point of who you put in it is the most important. But it's really hard to attract that person if you don't do steps 1 and 2 right. So, again, just keep your eye down the road. This is long term. And I see too many people rushing in and buying the wrong properties and having a bad experience. It just doesn't have to be like that. It can be enjoyable, right?
Well, and here's and you and I actually, we didn't do it today, but it's actually on our virtual whiteboard of topics to talk about, and that's talking about buying in markets that had extremely rapid appreciations. Like, we bought into a marketplace that had, I think it was like 28 one year, 27 growth the year after that, and 58% the year after that. So it was like it was a frothy, frenzied marketplace, and we made some big mistakes. Right. And now time and wisdom and losing a few hair follicles have now shed some light on that. And you know what? I'm doing it a little differently this time. And as of you, and the advice that we're giving is a little bit different. You don't have to be frenzied in a marketplace to actually have a good experience of owning a piece of real estate. I think it was Don Campbell that once said that if your investments are exciting, you're probably doing it wrong. Go jump out of an airplane for excitement, but your investments should be steady Eddie, nice and boring, and it doesn't have to be. You don't have to line up around the block to get a piece of real estate. Maybe line up for concert tickets or going to see the hockey playoffs, but you don't have to line up to buy a piece of real estate or get behind 27 other people's offers. What chance do you have of getting any kind of an opportunity, right? So that's the next lesson that you and I are going to share. We're going to dive in that one, Jay, we might have to really open up and be very vulnerable in that one about sharing some of the big mistakes we made.
Well,
are you open, Russ, for it?
I'm open for that. And on a closing shot to that one is, buy for cash flow. Buy for cash flow, because it's that cash flow that will save your butt when the market flips over, when prices drop, and we'll hit the pause button there and save it for the video for sure.
Yeah. Couldn't have said it better myself. Okay, Jay. So until the next one, guys, always remember, keep sharing this message, keep pointing people to wherever you're listening to this or wherever you're watching this. We're only getting started. We got more to come. Okay. Cheers, everyone. Bye for now.
Thank you. Bye.
Well, I sure hope you enjoyed that video. 2 simple things to do from here. If you're interested in continuing your journey, interested in continuing to become a successful real estate investor, just below where you're watching this, there will be an opportunity for you to subscribe. And if you're interested in continuing your journey, there is a hand-selected video over here for you. It's been hand-selected for you to keep your journey going forward. Thank you very much.